You are watching the chart, and suddenly it happens. A massive, historic ceiling that has kept the price pinned down for months is violently shattered. The price is surging forward. For the average retail trader, the instinct is immediate. The line is crossed, the momentum is blinding, and the fear of missing out kicks in. They hit the buy button. But almost the second they enter, the buying pressure completely evaporates. The upward surge dies, and the price drops right back below the boundary. The sudden drop triggers an avalanche of stop-loss orders. The late buyers are forcefully ejected from their positions at a loss, their accounts bruised by what looked like a sure thing. Fast forward to the end of the day, after the market has closed. Look at that same chaotic event on a daily chart. All that adrenaline, that massive surge and collapse, is recorded as nothing more than a single candlestick with a long, thin wick sticking up above the line. It exposes a harsh reality about modern markets. The old-school rule of blindly buying the exact second a price crosses a line is a losing strategy in a high-speed trading environment. The vast majority of those explosive intraday moves aren't actual shifts in market direction. They are manufactured noise, designed specifically to generate liquidity. To understand why this happens, we have to look at the institutional players. These massive funds manage billions of dollars, and their sheer scale is an biggest operational constraint. If an institution wants to buy 1 million shares of a stock, they can't just click buy all at once. An order that large would instantly drain the available supply and drive the price sky high before their order even finishes filling. To quietly acquire a massive position, they are mathematically forced to find a massive, concentrated pool of willing sellers to take the other side of their trade, and they know exactly where those sellers are hiding. Retail traders tend to place their stop-loss orders in predictable clusters, resting just beyond obvious support floors and resistance ceilings. So the smart money initiates a temporary surge. They buy just enough to push the price through that boundary line, deliberately tripping the alarms on all those retail stop-loss orders. When a retail buy position hits its stop-loss, it automatically fires off a sell order. Suddenly, the market is flooded with thousands of panicked sell orders, which the institutions happily absorb to fill their massive buy position at a discount. Once the institutional order is completely filled, the manufactured buying pressure stops. The price sharply reverses in the true intended direction, leaving the retail crowd stranded. In technical analysis, this specific event is called a failed penetration. It happens when a candlestick's wick touches or pierces a key level, but both the opening and closing prices stay trapped on the original side of the line. This chart shows gold to US dollar bouncing between clear support and resistance zones. Notice the long candlestick wicks repeatedly poking through the blue zones, only to retreat. The wicks shows the intraday manipulation, but the final closing price reveals who actually won. The most effective defense a retail trader has against this kind of microstructural manipulation is remarkably simple: strict discipline. You wait for the daily close. By demanding the price not only crosses the line, but finishes the trading day above it, you naturally filter out the violent intraday swings. If a structural boundary is genuinely breaking, the institutional volume driving that move will easily sustain the price above the level through the final bell. This approach also requires a predetermined invalidation point. This is a specific price level that, if reached, proves your technical thesis is mathematically incorrect. You calculate and set this exact level before you ever risk $1 on the trade. Knowing exactly where you are wrong in advance removes the emotional panic when the market starts fluctuating intraday. But just like your entry, your exit must respect the same time filter. If you plan to exit when a support level breaks, you wait to see if the daily candle actually closes below it, so a random stop hunt wick doesn't force you out of an otherwise healthy position. Of course, no chart pattern offers absolute predictive certainty. Even the most rigorous technical setups rarely exceed a 70% success rate over time. But by refusing to jump at every intraday shadow and anchoring your execution to confirmed daily closes, you stop acting as the smart money's liquidity. You start trading alongside the true, undeniable momentum of the market.